The CEO of UnitedHealth Group was shot in Midtown Manhattan just as he was entering the Hilton, where the company was going to be holding their investor relations day. And we saw some unusual options activity, but the price action surprised some people. We're going to talk about that and then take a look at Intel as promised from Monday's live stream today on Open Interest. Hello, everybody, and welcome. I'm Mike Coe. Welcome to Open Mic. As I was just saying, one of the bigger news stories of the day, to be sure, was the fatal shooting of the CEO of UnitedHealth this morning as he was entering the Hilton in Midtown Manhattan, where I have stayed myself probably 100 times over the course of the last 15 years or so. Pretty brazen and shocking, to be sure. Almost immediately, some folks reached out to me as they were a bit curious about the price action in the stock after this took place. So I'm going to just pull up on my screen here. I'm going to just bring this down to a single day now, so perhaps we'll be able to share that. So this is the price action in UnitedHealth this morning. Unsurprisingly, there wasn't a lot of activity in the stock before the market opened, basically flatlining here. And then just before 9, the stock first fell pretty sharply by about $20, recovered, and then ended up opening a little bit higher. And some folks were wondering how that could be. Because in general, shareholders get quite rattled by uncertainty. And this would basically be as much uncertainty as you could probably have at that hour outside of any other kind of normal business announcement. And I would make a couple observations first. And one of the observations that I would like to make is that his tenure as CEO began, if memory serves, only a few years ago. So I'm just going to confirm this. I think it was 2021 that he became the CEO of the company. I should say, and those of you who have followed me for some length of time will know that I have described this company on more than one occasion as one of the more remarkable growth stories we've seen. A former colleague of mine who's now an executive there, Cheryl Skolnick. She's an economist, but she was also the head of research when I was at CRT Capital. She was a big fan of the company. So it was probably her top pick, I think, going back now to 2012, which is when I joined CRT. And this company has just had a remarkable trajectory of growth. And we can actually see that here. I'm just going to chart that for you all so you can kind of see what's going on. And I think this is, actually, let's see, I'll just put revenue in. I think that's probably fine. So we'll just put revenue. See if that pulls up. Does it? Yep, okay. Now, why is this relevant in this context? And I'm just going to blow this out a little bit more here so we can get a good look at it. The reason I want to bring up this longer-term chart of the revenue growth of the company and how far back it goes is because there are some companies that their share price probably depends very, very heavily on the person at the helm. I think Tesla would probably be as good an example as any of this. I think it probably would also be true of a company like Meta. But in the case of UnitedHealth, this is a business that has just had a remarkable growth trajectory for decades. And the C-suite at a company like this are largely stewards of a great business. And so, while of course it's tragic and we mourn the death of anybody before their time. It doesn't necessarily present material operating risks to the business when something like this happens. The other thing is that as a group, the healthcare space stocks were earlier today. They were doing okay also. So they actually opened higher, then they fell off a little bit, as UnitedHealth did, by the way. And then it recovered a little bit. One final thing I would say is that in a circumstance like that, to the extent that there would be any perception that there could be some risk associated with this, or maybe there's something bigger going on that folks would need to be concerned about, we did see that actually take place on the option side. So this thing typically trades about 6,000 put options a day. It traded almost 20,000, a little over 19,000. So we're dealing with more than 3 times the average daily put volume, all short dated. They were able to reach the CEO's widow and ask her, and apparently there had been some threats recently on his life. Why he was, if that was true, why he didn't have any form of protection, obviously we'll probably learn a little bit more about that. But I just wanted to make the point that I think the price action question that I got, and it's not one of the questions we have here, but I think that one of the reasons that we saw the price action we did is because this is a business that probably didn't depend exclusively on its CEO. Obviously, he was an important figure there. He's spent 20 years at the company, and obviously our condolences to his family. So that said, I think we can move on to some other questions. And as I had previously discussed on Monday, we will get to Intel, but we have some questions here and now, and I will get back to Intel, but some of these are related to some things that are moving pretty quickly. So Monday Morning Quarterback says, I allocated 1% of my portfolio to IBIT, that is the Bitcoin ETF. It's now 3%, so that's a quick triple. I want to sell half and replace some with call spreads. Thoughts about strikes and dates in an IRA, so gains are not taxable. Okay, so let's take a look at that. And I'll bring up options play so we can sort of give this some thought. And yes, I in general, I think that's a fine strategy to start contemplating some stock replacement strategies when you have those types of gains, if you're concerned about a pullback. So that is fine. One of the things I will say is that you can almost, you really want to make sure you spread these call spread strikes out quite a lot, because this is a volatile stock. Actually, we'll take a look at MicroStrategy too, because this is also true there. But what I would probably think about doing is at least capturing whatever the implied move is for the horizon that you're thinking about. So let's just say, for the sake of argument, that you are interested in going out a couple of months. And so we'll just pick up the 50s. I'm going to go like this. The first thing you can do is just take a look at what the implied move is by looking at the value of the associated straddle. So it's probably about $14 at least. So you could do something like this, which would be the 56.70. The truth is that you can probably even stretch it out a little bit more than that. You've had a triple here, as you've indicated. So unless you've been just steadily adding to the position, that actually wasn't clear. But I'm assuming it's because you purchase it and it's gone up quite significantly. So let's just take a peek here. One other thing you could potentially do is even stretch this out a little bit more if you wanted. So one standard deviation, and remember the implied move is going to be about 80% of one standard deviation. So if you're thinking about one standard deviation to the upside, that would be, the 73s or the 72s, in that neighborhood. That's going to get you something like this. Gives you a lot of upside participation. Risking just under $4.50, which is, a good discount to the current stock price. Less than 8% of the current stock price. be your risk. So I think this would be, a good way to do it. Now you could also consider, depending on your interest, if you were going to be willing to take it on a pullback, to do something like a call spread risk reversal. And in that case, you could sell a downside put that's, solidly $10 lower, something like that, maybe 20% below the current stock price. And you get a structure like that. But I will also point out, before recommending that, outright, that this is a situation where this thing is probably going to bounce around. So you can also just simply try to be nimble. And, one thing you could do is, purchase, an at-the-money call or just out-of-the-money call as a stock substitute, and then look to leg into spreads or sell some upside calls if you get a rally. Or if it doesn't and it starts to decline, then look to sell some puts to help finance it, because it's probably not going to track in a straight line whichever way it goes. And that is a way that you can sort of work your way into the structure. So when we describe these structures, don't think that it has to be set and forget that you do it straight away. If it rallies, you can sell some upside calls against it. If it falls, you could sell some downside puts to help finance it. Or sell some downside puts and adjust, things like that. The only downside is that if you elect to just simply buy those calls and not go into a spread straight away, that if it goes sideways, then you're just going to experience decay. So, and if you're doing more than one lot, so if you were going to say, let's just say for the sake of argument, you had 300 shares of IBIT. And you decided, okay, well, I'm going to sell 200 of those. You could buy 2 calls, sell 1 call, and then look to sell the second if it rallied, or sell a downside put 1 if it fell, and so on. So, depending on how many shares you're dealing with, those are ways that you can kind of trade around. And whether or not you should trade around, by the way, or just do it straight out, is going to depend a little bit on how fairly priced volatility is, how fairly priced the options are. We've only had options for a short time, so I'm just going to take this back to, it's almost not quite, so it's not even a month yet. But I'm going to put this in like that so we can kind of compare it. So this is the 3-month implied volatility, and you can see there is, a decent amount of premium relative to, and actually let me put this, let's put in 1 month realize. So you can see that the way it's been moving lately, I'll go like this, it's reasonably fairly priced, right? So if volatility keeps up about the way it has been, you should have an opportunity to leg into that. Now, on the other hand, if it falls back to where it was, or if that's your guess that it will fall back to where it was, then you would try to put the call spread on straight away because you're trying to offset the fact that options are a little bit overpriced. But I think they're actually fairly reasonably priced, given what we're looking at right here. Okay, Ranjana Gupta, thanks for tuning in. Good to have you back here. Do you have rules regarding exiting positions early with a certain number of days to expiration, regardless of P&L? And the answer to that is no. I will say that, when I'm doing something in the volatility space, I'm typically not going to ride it into expiration, because if you just, it's not really working in that case. So, for example, if I go out 30 to 45 days and buy one of those strangles, as I was talking about on Monday, and hedging it delta neutral, those options are becoming increasingly out of the money. If the S&P just goes sideways, what is considered a 20 delta option when it's 45 days away is not going to be a 20 delta option, and it's not going to have any gamma if it gets close to expiration. So I'm going to be adjusting that more based on my Greeks and the kind of total sensitivity that I want to have, and the total amount of theta that I'm willing to accept. So that will dictate those types of adjustments. And of course, one other thing, which is, it also depends on my thesis in the underlying stock. So if I'm playing something going into earnings, for example, once the catalyst is come and gone, I've got new information coming out, and I might adjust my positions accordingly for that reason. But I don't have a fixed number of days to expiration to dictate what I'm going to be doing with any positions. So I hope that helps. Dennis Shiabi says, is it possible to revisit the VIX spike of August 2024? We can, although perhaps you could be a little bit more specific about what it is that interests you about it. This is just in case, folks are struggling with this concept because, I brought this up more than once, but I'm just going to very quickly, again, highlight. And it occurred to me only after the last live stream that there was one thing I could refer to, which is that you can have a change in the implied volatility of the actual options themselves on a strike-by-strike basis, as well as see the observed shift in where the S&P is. So that was, I think, August 5th. So let's just take a quick peek at that. And we're going to take a look at, let me just double check. I want to make sure I have that date right. That was the 5th. Yes, okay. So here we are. So this was volatility on the 5th. Why don't we take a look at what the volatility looked like the day prior. And actually skew is, so I'm going to look at, remember that the VIX index, this is important, the VIX index is looking at S&P options that expire in precisely 30 days. So it's always looking 30 days out. So I'm just going to do this and look at 1 month, and then I'm going to look at 1 month, we'll call it a week prior, okay? And now I'm going to look at strikes, and that's actually, we must have a really big pullback, so let me see if I can, let's see, let's go to O, we'll go one, let's see if this works. Here we go. Okay. I wish there was more overlap. Let me see if I can get that a little bit closer. We'll go 2. Okay. So this actually is probably as good an illustration for how or why the VIX will move. One of the observations that I was making before is that the VIX will rise because as the S&P declines, you are looking at lower strikes, and due to put skew, those typically have higher implied volatility. So the strip of options, which is all of the options that are being used in the calculation, as you go down, all else equal, they have higher implied volatility. The other reason it rises and falls is because the actual implied volatility of those options goes up and down. And I think this image right here is a perfect illustration of both of these things. How so? Well, we can see that this right here represents higher strikes, right? So we can see the slope here of volatility. Higher strikes have lower implied volatilities. Lower strikes have higher implied volatilities. And we can see also that in this case, it's observing a lower set of strikes on the 5th, so that's this one, than it was on the prior Friday. But we can also see that individual options rose in implied volatility as well. So I'm going to do that and just say, look here. Okay? So 2 effects helped cause that spike in the VIX. One was that the S&P fell, so you're looking at a strip of options that had higher implied volatilities to begin with. But in this area where we see an overlap, we can see that the implied volatilities of those individual options also rose. So when you get both of those things happening at once, the VIX is going to move more sharply. If you have measured moves lower, then generally the implied volatility of the individual options doesn't spike so much. And so you will see an increase in the VIX, but it'll be a steadier increase. And it's just a function of the S&P moving sort of up and down the vol surface, if you will. So I hope that that helps your understanding. And if you had a more specific question about that, put it in and we can get to it. Okay, Monday morning quarterback then has a follow-up question. SPX very frothy, 15% above the 200-day simple moving average, RSI of 70. Time to start nibbling on February hedges. My view of this is absolutely, and you know what's interesting, because I was thinking about this morning and then I got distracted by other things, and that was that we also had vol really dip at first. It was sub 13 right off the open this morning. And I thought, this is going to be a good day to hedge. Let me make sure to do that. And then, the UnitedHealth thing happened, and that sort of caught my attention. And as a result, I wasn't, really paying attention. Probably shouldn't really care 30, 40 basis points in the VIX. Probably shouldn't be, the end-all, be-all in terms of whether you do something. Oftentimes you're looking for confirmation anyway, so, you're never going to bottom tick or top tick anything. But yes, it was 100% my impression today that, I should do some SPX hedging. Now, I can't use SPX in here, but SPY is a good proxy, so let's just take a look at that. And I think at this point I might also quickly articulate what I was discussing before when I said there's a couple ways to hedge. Are you just trying to buy a volatility hedge, or are you actually trying to buy a combination of something that will give you some Vega exposure in the case that volatility rises, plus some short deltas, essentially taking some money off the table or at least protecting your downside? And I think that's something that you can consider. So what would that look like? You could use puts, and I'm just going to switch this over. It'll do this automatically. You could get some puts, maybe some 30 delta puts that expire. I'm just going to use January regular way. So the 30 deltas are going to be something like the 598s, like that. Cost less than 1% of the current underlying. Give you some good bang for the buck. You could conceivably also put that into a spread if you chose. Usually, if I do put something into a put spread like this, I will actually still try to get some of that delta. So I'll actually bump the strike that I'm long up a little bit. So I'd probably go, in and around here or something like that, and then look to sell something against it that's we'll get down here. I'll just use the 575s for the sake of argument. It's going to end up looking a little something like this. So you still get a good payoff, sort of, in this case you're spending $4 for a spread that is, in this case, $27 wide. So you're still getting better than like a 4-to-1 payoff, something like that. But I will typically adjust the delta of the long put higher. So I'll get a higher delta offset by the one that I sold. So if I was looking for a 30 delta put, now maybe I get a 35 or a 40 delta put offset by the sale of a 10 delta put. And sort of get into that neighborhood. Although right now I don't think outrights are such a bad idea, particularly if you go through the new year and if you manage to push this out past the inauguration, which I think is what you were suggesting by talking about February's. And if I didn't, I'm just going to make sure I'm sharing your thing here. So that's another possibility. So now I want to quickly touch on, before we move to the next question, what I do when I'm trading just the vol side. And like I said, I usually use SPX options for this, but I hedge the deltas with SPY. And chances are your broker will give you cross margin benefits if you do this. But what might something like that look like? Okay, so in that case, I might be looking to get maybe a 20 delta call and a 20 delta put, both long. And this is 58 days. It's probably a little longer than I would go, but so we're going to go like this. Yeah, we can just pick the 630s. Why not? And what was that delta there? That was a 23 delta. Okay, that's fine. And then I'll pick up a 23 delta put or a 20 delta put. Something like this. Okay. Now bear in mind, if you're looking at this structure and then you see a very low options play score here and a very low probability of profit, The app is not assuming that you're hedging your deltas, okay, which is actually what I do. So in this case, this is going to be delta neutral when you first put it on. But as the price goes down, so you can see this is the instantaneous curve of exposure. You can also think of this as how the delta is changing. So that's basically a picture of your gamma, how your delta changes with the price change of the underlying. So let's just say, for the sake of argument, you put 10 of these on, okay? So once you get up into this area here, this thing is now, it's obviously not 100 delta, it's not trading like a put, but it is going to be trading with probably about a 50 delta. So a 50 delta on 10 lots, so if it gets down to 585, so if you see a 20-point drop in SPY, this will be a 50 delta. So if you had 10 lots, that's 500 shares. So I would actually be buying 500 shares at that point. And then, of course, if it rallied, the opposite would be true. So maintaining a certain amount of delta neutrality. For my own purposes, I do not typically hedge deltas if it's not a round lot of the underlying stock. But depending on what size you trade in your own book, that may not be suitable. So you might want to trade smaller amounts. You're not going to. I don't typically trade 25 shares of SPY or 50 shares of SPY. I'll trade 100 shares at a time. So I wouldn't. One way to think about this is that I can get down to here and say, okay, this would be a 10 delta. I probably wouldn't be buying any stock until we got down to, what is that? Down $8 or so, something like that, $8-9. But that's how you do that. And here's what happens. As time passes and you're buying the stock as it falls, and then as it rallies back, you're selling it, and so on, you're trading your gamma, that changes your probability of profit somewhat. In truth, what your P&L is actually going to end up looking like is something like this. Because what's happening is you are spending a certain amount of volatility for those options, and your dynamic hedging of those options is going to be your realized vol. And how much you make or lose is going to be a function of the difference between what you paid and what you got. So let's just quickly, I'm going to go out and just say this was about 1 month or close to 2 months. We'll do 2-month options. Okay, so that's the implied volatility. And let's just, we're going to say 30. And let me put the spread in here. So this is what you're going to make or lose. Okay, so when you, and actually I should flip these around because this looks like a profitable trade, but actually it's deducting realized vol from implied, and I really should be doing it the other way around. So I'm going to do that now. And if anybody has any questions about what I'm doing here, what I'm doing is I'm saying, okay, here's the price of the option. So this is what I paid, so that's what I'm going to have to pay away. And realized vol, if I'm hedging my gamma, is what I get. Right? So if realized volatility, so this is kind of what your P&L would look like. Right? So if realized volatility spikes, I'm going to make more money. And if it falls to some very low number, then I'm going to lose money. How much am I going to make or lose? Well, as a rule of thumb, one way to think about it is, well, how much am I spending in terms of Vega? So we can actually go to that. Let me see if this has this. We sort of are taking on, I hadn't anticipated the conversation was going to go in this direction, but I'm kind of glad it did. I think there's a decent amount of utility in kind of understanding this thing. So I'm going to just go out to that expiration. By the way, I see I'm getting a message from Fausto Pugliese. He runs an outfit called Cyber Trading University. Not sure if any of you guys are familiar with him or not. If anybody is, let me know. I met him while I was in Miami at that conference, and he's holding an event next week. I'm going to be speaking at one of them, so might be worth a gander if you're interested. Okay, here's the way to think about it. So you want to know approximately, and hang on, I need to add some additional information in here so that we can get a good. What you want to know is approximately, let's just say I did it with a straddle. I'm going to put this in. You want to know how much you made or lost. You want to know how much Vega you took on, right? So the Vega of this option, in this case, I'm looking at the January 607s, which is pretty much the at-the-money put. That's 82.90. So if I had 10 straddles, so it's going to be 82.90 times 20, right? Because the Vega is going to be the same for the calls and the puts. If I have 10 calls, 10 puts, there's going to be 20 options in total, so it's going to be 83 times 20. So it's going to be about $1,700 per vol point that I make or lose, assuming that I, hedge it in a way that's pretty consistent with what realized volatility turns out to be. That's how you kind of think about how much you're going to make or lose. Now, you'll ask yourself, well, why is that a hedge? What it really is a hedge against is two things. Because you're not taking on if you trade it this way, you start delta neutral. So you're not necessarily getting a benefit in terms of hedging straight away if the market declines, because puts are short delta. Shorting stock is short delta. This is not that. It becomes short delta. So where it's going to do the best for you is in a couple of situations. One, realized volatility spikes. The market just starts chopping around a whole lot, and you start making money on your gamma hedging. So that's one way you can win. The other way you can win is implied volatility rises in response to that. So you could spend, we'll call it $10 on a structure, $10 a share or something like that. And all of a sudden, so that's, $5 for the put, $5 for the call. And all of a sudden implied volatility rises by 30 or 40%. So even though time has passed, the structure is actually increased in value. So that's another way that you can potentially profit. The final thing is that if you ever had something where there was what we call a price jump, so prices aren't continuous, that's kind of the ideal situation when you own options, is that all of a sudden the S&P drops by a big amount. That will pay off more handsomely. And the reason it's going to pay off more handsomely is because you're going to get both of the things I just discussed, which is realized volatility rose, implied volatility is going to rise. But the most important benefit to you as somebody who had that structure on in a delta neutral way is that you weren't hedging it on the way down. If the S&P is 607 right now, and we wake up tomorrow and the S&P is down 100 handles or 10, so that the SPY is opening 597, I didn't buy some at 602. I didn't buy some at 600 and then at 598. It just went straight down there. So I got all of the benefit of being short delta, my increasing amount of short delta as it went down there, and then I covered. So, there's an old saw with options trading, which is that I want the underlying to run to my short strikes, but I want it to blow through my long strikes. And this is the reason, right? Because you're not going to be buying all of that stock on the way down. If it just gaps down and then you cover, you'll have sort of made the most that you could out of it. So I hope that helps for you when you're thinking about that. Alex V, some Lamborghinis in the background. Lamborghinis. Not 100% sure what you're referring to. Maybe driving by, you may have heard. So unfortunately my street is periodically used by people taking test drives at a couple nearby car dealerships. And it's not a Lamborghini dealer that's close by. It's Ferrari, Maserati, and Porsche. So within a mile of my house, I have a Ferrari dealer, Ferrari of San Francisco, Maserati. They could potentially have Lamborghinis over there. And then the Porsche dealer is also a similar distance. And yes, they test drive close to my house. There's a little peninsula here. It goes by the bay. And actually, 2 Ferraris have landed in San Francisco Bay test driving in my neighborhood. One of them was last week. I couldn't quite make out. You can look it up, but it's probably, I'm sure it was in the news. I saw a picture of it. I couldn't quite make out which Ferrari it was. I think it was a Ferrari Roma, but it was a big muddy mess. So yeah, if that's what you're referring to, sorry if my microphone picks that up. And it's not too bad. They actually put a stop sign very, very close to here because we kept complaining about people hauling ass through here. But yeah, if that's what you're referring to, maybe that's it. But yeah, Ferraris, Porsches, and Maseratis, more so than Lamborghinis. There's a Lamborghini dealer about 5 miles away. Okay, can you discuss why T was in play yesterday? Okay. So, let's take a look. How much of a move did we experience? It wasn't that big a move, really. Maybe you can be a little bit more specific. Was there an options trade, Brad Holt, that you were looking at specifically in AT&T that caught your... Let me take a look here. Let's take a peek here. What's going on? What have we... Oh, here we are. Oh, it gapped. Oh, I see what you're saying. So it gapped. You're wondering why it gapped up on Tuesday, I assume. Let's take a look here. So it's based... Yeah, I mean, it's a little bit lower on Monday, but then it gapped up. What do we get here? So, well, there's your answer, I guess. Got an upgrade. So slight profit increases, got an upgrade, and announcements of a buyback. It's kind of a little bit peculiar given its level of indebtedness as far as I'm concerned. But that looks to be the reason. So there you go. Let's see here. What PC says, what is an option strategy equivalent to a 3x ETF in terms of the original ETF? Example, options strategy on XLF compared to going long on FAS. I just want to make sure I shared that. Okay. So here's the curious. This is an interesting. This is kind of interesting, right? Because a levered ETF. So let's compare and contrast this for a second with a customer portfolio margin account. So if you have a customer portfolio margin account, you could buy XLF on 3x leverage, right? And you could achieve that. The difference, though, between that structure and a 3x levered ETF is that you could potentially experience a margin call in the event that XLF fell, right? If you had 3x leverage. FAS, this isn't the case. So in order, because you're only going to be committed to posting as much, it trades like an equity. So there is no margin call for you. So in order to accomplish that, the underlying fund needs to deploy leverage in a way that it doesn't have that eventuality. So it can never end up upside down. So if you have something that's 3x levered, they need to use some optionality to essentially get that upside participation without the possibility of blowing out. So if it opens up down 75%, if you had 3x levered on XLF, you would get a margin call and you would owe money. But with FAS, that's not the case. Why is it? It's because the fund has to have some derivative exposure underlying. So what could you do to achieve something comparable? So the objective is to get 3x levered on a day-to-day basis. And what you'll find is that over the longer period of time, it doesn't achieve this. And let's illustrate that. So we're just going to talk about the stocks first. So if you take a look at XLF going back to 2019, so this is a 5-year period now, you can see that the total return was 87%. And if you'd bought FAS, your total return is 110%. That is well short of 3x levered over the long term. So what does this tell you? One of the things it tells you is that FAS is a trading instrument. It's a way to get leverage in the short term, but there's a significant cost. And in fact, what we can see is that over the long term, you have outperformance here of only 23%. So the decay, it's supposedly giving you 3x leverage overnight, but over the long term, that decay is significant. So what would be a functional equivalent as a trading vehicle? Well, if you could own call options instead. Now, a quick point I want to make is that if you were going to use call options to get that upside participation, the way we might normally think about doing it would be to buy an at-the-money call option, maybe slightly out of the money to the upside, but that's not going to give you the delta that you're looking for on an overnight basis, because remember, you're getting something that has an overnight delta of something close to 3x, right? So in order to achieve that, you actually would need to have something that is in the money, or you need to have a pile of options that are out of the money. Let me illustrate both cases, okay? So first things first. So XLF is trading 50, and you want to have 3x leverage. This is going to trade essentially like the stock right here. I might even go a little bit deeper. So 50 will go down to 48 like this, okay? So it trades effectively like the stock in this region. There. And you just multiply that by 3. So now I'm going to commit $7.50, you know, that because I'm buying 3 of these $2.50 calls, which by the way are $2.25 in the money. These expire in January, so my decay instantaneously is not going to be that great, and I'm going to get that 3x leverage. Okay, so that's one way you could do this. The other way you can get 3x leverage, because you can see this is behaving almost exactly like stock. If you buy an out-of-the-money call option so that you can get more convexity, if you want instantaneous exposure that is 3x, you have to buy a lot more of them. And that is because the delta of those options you need to have. So if I was buying that 48, that's 100 delta call option. So I could just buy 3 of them, and that's 3x. If I buy a higher strike call option, like the 51s, which are 44 delta instantaneously, in order to get my 3x, I'm not going to be able to get it exactly. I'm going to need to own, well, somewhere between 6, closer to 7. So then I would need to own 6, we'll just call it 6 of these. The idea being that if it really ramped up, you'd get a little bit of benefit. 7 would ultimately give you more exposure. So here's another way you could accomplish it. This is going to give you also instantaneously, the delta of this is the equivalent of 300 shares of the underlying XLF, right? So there's a couple ways you can skin this cat if you want. You could buy more upside calls, but if you buy more upside calls, then it has to get there in order to be profitable. If you get some in-the-money calls that are close to 100 delta, as this is, holding this position has $75 worth of decay, because these call options are 25 cents of extrinsic premium apiece. So 75 cents in the aggregate, right? So that's 75 cents over 50.26. So you're paying 1.5% of extrinsic premium to get 3 times leverage. And actually some insurance, because of course if it goes below 48, you're in the clear. You don't have any exposure. So if you're looking for leverage, this would be a way to accomplish this, and it could be, you know, this could be better. So those are 2 ways to to accomplish something like that. And I generally favor this over using these levered ETFs if you have anything except an overnight position in mind. And the reason is because here we know exactly what your total risk is. We know exactly what your underlying structure is. It's a little bit more nebulous when you're using something like FAS instead. So I hope that helps. Cody Willard is making a bullish case for Pfizer, calling it AI healthcare revolution. Too optimistic? Yeah, I imagine I'd... Really? AI healthcare revolution. I'd have to see more about why they're saying that. First of all, there is an AI healthcare revolution going on. Very interesting when I was at that conference listening to those that are focusing on the applications of artificial intelligence to healthcare. I may have referenced this before, but I think it's worth... I'm just going to let you guys go and look into this on your own. But you will remember that Big Blue, that was IBM's AI game-playing machine that basically conquered chess. Then Alphabet introduced AlphaGo, which was their artificial intelligence solution that was able to conquer the game of Go. Eventually, they had a couple iterations of it. So in the healthcare space, there was a contest that was held where experts were supposed to describe these folding proteins and predict their shapes. And every year they would hold this contest, and people had to predict the shape of a folding protein. And artificial intelligence decided to tackle that game as well. And the contest is essentially all but over, because they placed 20th their first year, they won it the second year, and now apparently they have described the shape of folding protein, every conceivable folding protein, which is another way of saying that, you know, it's growing at such an exponential rate that the benefits for healthcare and our understanding is tremendous. So I think we're going to see a huge transformation in healthcare. There will be a revolution. It will be AI and robotics related. Do I think Pfizer is at the center of all of this? That would surprise me, given that there are a lot of other companies that are focusing on these problems that I think already have them. So anyway, I'd have to look into that a little bit more. I mean, I've also been a little bit chronically disappointed by Pfizer. That is to say that for the longest time, they did not have a great pipeline. They weren't replenishing the things that they had. They obviously got a huge win from the vaccines related to COVID and gave all of that back, as I think it's not quite the remarkable panacea that folks at one point thought it was and was going to be. Consequently, it's not my favorite. It's not my favorite stock. Spicy Barbecue. Hi, Intel had an ugly week. That said, do you like a short strangle on it? Yeah. So here's the thing about Intel. I was giving this some thought because obviously we were talking about it a little bit on Monday. You can see just by taking a look at the company's performance that this isn't one of the names that would normally appear on my radar. I'm not crazy about companies that are not growing faster than the economy, and this one is shrinking. I don't like investing in companies that aren't profitable because profitability makes up for a lot of other mistakes on the long side, and Intel isn't. There's something else, which I think this is kind of interesting too, maybe, is that if you take a look at what Intel sells and who it sells to, their biggest customer is Dell, right? So Dell accounts for 19% of the company's revenues. They're building the chips that are in, you know, our computers. Compare that instead to where AMD sells all of their product, or Taiwan Semi sells all of their product, or NVIDIA sells all of their product. I'm going to bear with me because I'm just going to tab between these. So I'm just going to load all of these windows up so we can just compare them one after the other. And it's just not that exciting. They're Taiwan Semi is selling their products to Apple and to Nvidia. Intel is selling it just to Dell and Lenovo. It's the desktops and laptops. AMD's got Sony and Alphabet, Amazon, and Nvidia, of course, to anybody and everybody who wants their Blackwells and their GPUs and you name it. Intel has to get to a point where they have built a sexy product that people want to put into their machines, and they haven't gotten there. And I appreciated that they were doing the right thing by putting an engineer at the helm, because I think that's where the company sort of lost its footing several years ago. But they have not, they haven't done enough to correct it yet. So this one isn't on my radar. That said, so the first things we want to take a look at is, okay, what are the potential catalysts? Well, obviously, C-suite changes are potential catalysts. We have this global technology conference that's going on next week. That's a potential catalyst, I guess, but UBS is holding one today. So then in January, we've got these earnings. So the real question for us now is, do we think that the options premiums are reasonable to sell? Let's go out. Oops, sorry. I want to go out. We'll call it, we'll look at maybe a 1 month option. And we'll compare that to how much the stock's moving around. We had, because of the CEO stepping down, we got a little bit of volatility out of that. But you're collecting a decent amount of premium, right? So 47% implied. And let's just take a look at the price and decide where we think it would be attractive to potentially sell around it. The lows that we saw here, this was $18.50, and the recent highs were 25. So let's just take a quick peek and see whether we can get anything for a strangle. It doesn't have to be at those absolute lows or at those absolute highs. And in fact, what's interesting is that if we thought it was going to be range bound, choosing those strikes in particular might not be the best ones. You probably want to get paid assuming it's not going to violate those, rather than lose money assuming it did, if that makes any sense. So how would you go about doing something like this? We're going to try to sell a call, sell a put. You're going to get something that looks a little bit like this. And you get a downside break even of 17.5, because remember, you're collecting premium, so that's below that those lows, and 25 on the upside, which is above those highs. So I think a structure like that could potentially make some sense. In case anybody wants to, if you can't see because I'm sort of flying around here, I was just going out to January, regular way, 1924, something like that. Yes, the short version is I think that's probably reasonable. And this, by the way, that does not capture, I don't think that captures the next earnings. I have to, it's an estimate, of course, but I think that actually the next earnings is a little bit later than that. But that's, and look at what you're collecting, right? So you're going to get, we'll call it 80 cents and 30 cents, $1.10. So you're going to get $1.10 on a $20 stock over the course of a month and a half. Not a bad rate of return. So yeah, I think that's fine. Normally I'm not crazy about selling strangles in stocks, because most of the stocks, as I talk about, hey, I want to be long stocks, so I don't like to get naked short the upside. But in Intel, admittedly, I don't feel like there's huge upside risk, if that makes any sense. Sonny, your thoughts on Lulu earnings tomorrow? I wanted to sell puts and don't mind having a position in it. Okay, so it's interesting because we did talk about this one on Monday, and I had previously, so it was on October 24th. I think we covered it on the live stream. I know I put out a piece on it on October 24th, and the thing that I had commented was that in the space, I absolutely preferred this company to some of their competitors, because I just thought it was trading too cheap on a relative basis. So that was back on October 24th or thereabouts that I had said that. Stock is up, it was below 300, I think. Yeah, it's still below 300. It's 295 at the time. Yeah, it's up. It's almost $50 higher now. And what I was saying is that that's huge outperformance compared to names like Nike. So I didn't mind a stock substitution strategy in something like this. Stock substitution strategy that I articulated on Monday, I think, was a call spread and a call spread risk reversal. A call spread risk reversal is financing the upside purchase of a call spread by selling a downside put. So I'm obviously comfortable with that as a potential strategy. And where did I put my... Oh, whoops, I must have closed it. Didn't mean to. So let me pull up options play again, just so we can illustrate this. The call spread risk reversal that I had illustrated, I think, was getting short the 300s to the downside to buy an upside call spread. The idea being that the stock was on or about or near that $300 price before it took off when I recommended it most recently on the 24th. If you were just looking to sell a put, why don't we just take a look at that, what that would be. Bear in mind, I don't like selling puts unless I'm getting at least 1% of the current stock price on a monthly basis. To do so, here you would be getting 6, which is 2%, over the course of a month and a half. So that's acceptable. The thing is that going into catalysts, I usually want to see a lot more than that. So that's my only reservation. It's probably a 9%, maybe a 10% move, but let's call it 9. That gets us down to 310 to the downside on earnings. It's possible. Let's see if we can shorten this up a little bit. How much? Let's see here. Let's go down to 310. 310s that go out only 1 month. Something like that. Yeah, that's okay. It's okay. But my attitude about it is that if you're, I'm not usually jazzed about situations where I'm trying to make 1 or 2% per month on a stock. Writers are going to be reporting when they're averaging an 8 to 9% move on earnings. And this thing, performed really well going into it. And by the way, if you didn't watch on Monday, I want to just show you what I was looking at. That in addition to the fact that the stock was up nearly 12% since I recommended it, this was the thing that had me a little bit concerned about this particular earnings result. This is 2 sources of alternative data on the company's sales. Some of it, you can look at foot traffic, you can look at observed sales from debit and credit cards. I just happened to notice that it felt like it was weak, felt like the analysts kept lowering their expectations. This isn't a huge surprise because it was trading 21 times earnings when Nike was 25.26, the S&P was 25.26, consumer discretionary was trading 28, 29 times forward. So clearly, just the valuation alone told us that the estimates were too high. Right? There was no way to justify that valuation gap unless you thought those numbers were too high. Because the original numbers, I think, were forecasting something like 8% year-on-year growth. If you figure that the S&P is going to do 6.5 to 7, and it's trading 25, 26 times forward, and you've got a company that's growing at 8% year-on-year, you would expect it to trade at a premium, not a discount. So the discount itself told you that the street wasn't buying all of it. And I think this is the reason why. That it looked, we see consumer data that looked a little bit weak, or even very weak, I should say. Delinquencies, credit card balances, savings, that kind of stuff. And the observed sales coming from alternative data, all a little bit weak. So my thinking was that I rather liked the call spread risk reversal better because my hope would be, I'm going to just compare it. So there's that trade. So this is what we talked about, and I'm just going to structure it right from here. And we looked at weeklies because remember we wanted something that had dollar strikes. So I just take the 345s and call it I'm just going to say a 10% move to the upside. So that's going to be $35, round numbers, right? So $35 gets us to 380. So sell the 380 calls and then sell a downside put to help finance that. You get a structure that looks a little bit like this. This will have some decay instantaneously as vol falls, and you're short more options than you're long. So if you're comfortable owning the stock, my 2 cents, I'd rather have a structure like this because I still have the opportunity to participate meaningfully if the stock does well in exchange for what, 1-2% of the current stock price to the downside. I think I'd rather trade that 1 or 2% for better participation on the upside. That's just me. Especially going to a catalyst, the stock's likely to move, and if it doesn't, it's no harm, no foul with this. Okay. Tucker D. Dog, what and when was that event you said you were speaking at? Is it in person or online, free or fee? It is. I'm pretty sure it's going to be free because it's Cyber Trading University is the one that's holding it. And I'm assuming it's free because when I asked about it, they said, we're going to be broadcasting this on YouTube, on TikTok, on X, on Instagram, Threads, or whatever. So they were going to just be blasting it across a number of different outlets that they have. So I assume if you're just watching the Cyber Trading University YouTube channel, which admittedly I have not done myself, but it's focused a lot, I think, on technicals. But, like I said, I had a chance to meet the founder. He was a professional trader. He was, what we used to refer to as the SOS bandits back in the day. Not always, for institutional traders, those were not necessarily our favorites, but, a real market participant who's been at it a while and has some meaningful insights. And he's got a lot of people working for him from what I can tell. So it should be interesting. And I'm always very interested to sort of combine, my more fundamental and options-based approach with people who are, principally interested in technicals, because the fundamentals, as I've often said, give us comfort when we take bets on the long side. We take a look and say, are we comfortable owning these stocks? And why are we comfortable owning them? But in the short term, the markets are a voting machine. It's only in the long term that they're a weighing machine. So I'm always interested in the insights of people who focus on the technicals. And it's going to be going on for 2 days. So I'm going to be speaking, I think, on the 12th next week, but I think it's the 12th and the 13th. So not just to watch me, because you guys are watching me anyway, but check it out. Might be interesting. Okay, so that was Lulu, which is okay. Okay, so you are okay. Oh, looks like we're running up against the time here, but let's see what we've got. So someone is asking about this shale play here, PED, Pacific Energy Development. And what is your question on this one? No debt. Book value of $1.19 a share. So I don't really look at penny names that often, to be honest. Yeah, I will, always a little bit interested. If somebody tells me that there's more book value per share than the current stock price, and if the company is not losing money hand over fist, so it's got negative free cash flow, $10 million in trailing negative free cash flow, and a $4.6 million cash position. So that would be one potential area of concern. Let's take a look at its book value. So, to your point, does look like, at least by Bloomberg's estimate, it does appear to be trading at below book value. But they need to raise capital because they have a cash flow situation, which is almost certainly going to be dilutive, and that I think is what that is implying. But yeah, it's worth thinking about. It's not my area though, admittedly. Okay, so we have chewed up, unfortunately, a little bit better than an hour of your time. And I, as always, really appreciate you guys tuning in to have a listen and for all of your questions. And if there are ever questions that I fail to get to, I will endeavor best that I can to at least talk about the stock on the subsequent live stream. Some of these penny ones, it's going to be a little bit difficult because admittedly, I don't have access to that much information on those to really delve into, and I would really have to go into their filings, and then I have to trust their filings, right? So, not typically the space that I'm going to be looking at, because I have always tended to approach this from an institutional perspective, because that was always who I was working for and with, and those companies didn't typically represent something that we were able to for liquidity reasons or for LP restriction reasons. There would be a lot of reasons why we wouldn't be looking at stocks like that. So it's kind of outside of my purview. I apologize for that in advance for those of you who are really interested in penny stocks. Doesn't mean I won't ever look at them, but I have done. I did in American Airlines when they were in bankruptcy. That was a penny stock. It was trading 50 cents a share, and we did a lot of work on that because our credit department had basically researched every asset that the two American Airlines entities held. So there was an operating company and a holding company, and they knew the serial numbers on the tugs at the gates. So anyway, thank you all very much for watching. Like, subscribe, tell your buddies, and tune in again next Monday at 4:15 Eastern. Thanks for watching.